Hey, welcome to the live stream. This is Victor with Victor H Investing, and I wanted to stream and catch up on what's been happening this week with the stock market. Take a look at what trends I'm seeing out there with stocks and see what I think the market's going to do. We'll take a look at some individual stocks. We've had some pretty big earnings today that got announced, and we've had a few earlier in the week that we can talk about. So, let me go through some high level, just some observations of the market. Then we'll get into some specifics around the earnings that were announced. If you'd like me to take a look at a stock, I'd be happy to do so. If you're a member of the channel, feel free to pop it into the chat. I'll review it. Just put the ticker in there. If you're not a member, $5 on a super chat, and I could review a stock that you'd like me to take a look at. So, hey, Saeed, very good to see you. Thanks for joining. I hope you're having a good week. So today we had kind of a mixed day. And overall, when we look at the U.S. markets, they did trade down. The NASDAQ was down 0.83. S&P was down 0.53. And the Dow Jones was down 0.25. The S&P for the year to date is up about 1%. So we're still in positive territory. But it's been kind of a mixed day where you've had some pessimism. And then I looked at some of the earnings in after hours, and some stocks are trading down, which is interesting. We'll see if this negative market persists into tomorrow. So overall, the S&P is just barely in positive territory, had that big correction earlier in the year, and it's really battled back to get to where it's at now. When we look at the some big names for today that did well. I would say that I would point out that CRM Salesforce did well. Microsoft had a really good day. Uber had a good day. And some of the semiconductor stocks like Applied Materials did really well. Netflix had a really good day. Capital Markets had a good day. There was an IPO, Circle, and maybe we can take a look at that one in a little bit, because that IPO today, and boy, did it rise. I haven't caught up with it, but the last time I took a look, it was up, I don't know, 100%. It was up high. Mike, the dividend investor guy. So today has been a big day for the market. Overall ugly. Yeah, it was kind of ugly news. And man, I don't know if you've seen, Mike. Yeah, let's take a look, because I took a look at DocuSign. It's down big, like 16% in after hours. So that's going to be an ugly report to look at. I'm not quite sure, because it seems like DocuSign, after earnings, the market sells it off really hard, and then it rallies back maybe a couple weeks later. So if it continues to do that, it might be a good opportunity. So I'll look at DocuSign in detail and let you know what I think there. So let's do this with the heat map. So we've got some stocks that did okay today, but let's look at the 5-day, showing 1 week of performance. And over the 1 week performance, boy, Meta's had a nice week. Netflix had a nice week. Broadcom's had a nice week. It looks like Palo Alto, really nice week. So some Eli Lilly, really nice week. And when we look at the month, some of the usual suspects: Broadcom, NVIDIA, stupendous 1 month charts or performance. Meta, good month. Disney, really good month. All right, Mickey Mouse, up 21%. Amazon, up 9.44%. There's a lot of green over the last month. It's been a really good month. The month of May was a really good month for my portfolio. Hopefully it's the same for you. And when we go to year to date, this is a little bit more data. Meta's having a good year, almost 17%. Broadcom, good year. Microsoft, good year. Apple, terrible year. Berkshire, ever since Warren Buffett announced that, hey, he's stepping down, letting his successor take over, this stock has been going down. So it's interesting that year to date it's 7.82. It was leading the pack for a while. Netflix up 40%. Incredible. GE up 51%. So there's some big winners, but it's, to outperform the market, you have to pick the right stocks. You have to find them, buy them at the right time, hold them for the right duration, and then beat the market. And in my case, I like to diversify because I'm not smart enough to know that, hey, I'm going to pick this one stock and it's going to take me to the promised land. And so instead, I buy good companies. I try to buy them when they're discounted. When I look at the intrinsic value of those companies based on cash flows and earnings per share, find them at a discount, buy them during a good period of time, and then hold them. So this year has been a stock picker's year, and that's how you can outperform the market. Even the best hedge funds have been struggling this year. If you look at super investors, this is pretty up to date. David Tepper is up 12.96. Burry's up 12.83. But you see a lot of big names that are underperforming the S&P, like Howard Marks, Rob Vinell. Warren Buffett is in the negative. These are the stocks he owns, not Berkshire Hathaway. Bill Ackman's in the red. Lee Lu in the red. Pat Dorsey in the red. Druckenmiller way in the red. Manish Pabre way in the red. So even these real good professionals, they're struggling this year. So picking the right stocks, like Burry did a nice job. Tepper, did a nice job picking the right Chinese stocks, picking the right tech stocks, and he's doing really well. So even the big, successful guys are having a tough time this year. Now, it is a really good idea to manage your own portfolio and pick stocks. When you look at how beautiful those buildings are in New York City on Wall Street, and they're tall and they're clad with all this really expensive marble, and you see the salaries that are being paid on Wall Street, guess who's paying for all that? Passive investors. People who just buy mutual funds, ETFs, let the smart guys manage their money. But the smart guys are making a lot of money off investors, earning 1-2% just overall management fees, and then sometimes participating in the upside gains. So yeah, they love managing your money because then they could get really rich. But I would encourage you to take your portfolio and manage it directly. Buy great stocks, buy great companies, continue to learn, continue to get better, and avoid all that cost of Wall Street wants to make off of you. And instead, keep it in your portfolio. And the smarter you get, the better you get at investing, the more money you're going to make. You're going to be able to keep it all. That's the decision I made years ago. I did hire professional advice to help me with my wealth. I wasn't happy with it because it was almost like they were just collecting money from me and not providing enough value. So I'm not saying every hedge fund manager is bad. I'm not saying every wealth manager is bad. I'm just saying if something's really important, I want to make sure that I understand it and I get better at it year after year. That way I can wake up every day now and feel financially secure, financially independent, and have the ability to outperform the market. You don't get there overnight. You get there by doing it, by learning, studying the great investors, learning a process of how to value a company, and being able to invest in it at the right times. So I encourage you to think along those lines and avoid making the fortunes for the big Wall Street hedge funds and the Wall Street companies. I love companies like Robinhood that are taking these old paradigms, these old ways, right? Where everybody just depended on Wall Street firms to invest in equities. Well, now anybody can invest. You can go to Robinhood, eToro, E-Trade, you name it, and you can invest. You want good information? Well, you're on YouTube listening to me. There are so many good resources online. There's great books by great investors, and they're so generous with how they view the markets, how they invest. Pat Dorsey's excellent at that. Warren Buffett's excellent at that. And they tell you exactly how they do it. So you just have to read, learn, practice, and learn from everything you do, both success and failures. You'll be a great investor. All right, so we've got a market that is a little bit hit and miss. Now let's take a look at some earnings that came out. So today was a big day. We had Broadcom, which is a big market cap at $1.2 trillion. Lululemon, right? It's a pretty popular stock because they do all those leggings. I know my wife owns a bunch, and it was really doing really well for a long time. Samsara, which does Internet of Things, a technology company. Rubrik, which I think does quantum. So I wanted to take a peek at that, and then DocuSign. So let's start with the biggest, and then we'll work our way down. So it looks like Broadcom announced the market isn't in love with their financials, but you know, the company, I read through their financials, they're growing their top line revenue by 20%, and they're guiding that next quarter is going to grow by 20%, which is impressive, but I think the stock's too expensive. The reason why they're larger than they were before is they acquired a company that by the name of VMware. They integrated that into their business. So that's a good part of why they went from, let's call it 22 billion up to 54 billion is an acquisition, which isn't as good as organic growth. Organic growth shows that, hey, your product was so good, many more customers bought it. It's so good that you were able to raise your prices. Your product catalog expanded, and you're able to sell more to your customers through your network power. All those things are organic growth, but Broadcom did do some of that, but most of it is this acquisition of VMware, which in my book is not as good. So that's one of the things that I've always held. It's kind of a asterisk over Broadcom. I owned Broadcom for some time and I sold it. Now the market's selling it off a little bit. We'll see how it behaves tomorrow. So Broadcom had I thought a decent report. They also carry quite a bit of debt, by the way. They took on debt when they acquired VMware, and they carry $66.5 billion of debt, and they have about $9.3 billion of cash. So they have about $57 billion in net debt. It's not a terrible balance sheet, but it's not, squeaky clean. Like let's say a Google balance sheet with lots of cash, very little debt, far more cash than debt. That's not the case for Broadcom. Or NVIDIA. NVIDIA has a lot of cash, very little debt. Broadcom's a different picture. They borrowed a bunch of money. They bought VMware. Now they got to pay back that money. So we'll see what happens. So that is Broadcom. I'm going to create a full video. I'm going to do all the analysis. I'm going to get into my valuation schedule, and I'm going to publish that video for members of the channel. So if you're interested in seeing the detail of Broadcom, take a look at becoming a member. I think you'd be glad to do so. Let me show you where you could do that. So you go to my homepage of my YouTube channel, and you would go to this join button, and you would get the details of what you would have as options of being a member. And if you join at any level, you'll be able to see all the videos that I produce. And one of them will be Broadcom. The other one will be DocuSign, and you can see my research. So that is Broadcom. Let's look at Lululemon next. Wow, man, look at this drop. I'm seeing a lot of red in after hours. So Lululemon down 22%. Holy smokes, what happened? Shares sank on forecast. Wow. Let's take a look, see if their financials have been uploaded. Doesn't look that way. Now, they went from growing really good rates, and they used to grow at like 24, 21, and even got back up at 42, 29, and now they're down to 10%. And then the quarterly, the last quarter looked pretty good. It looks like growth is really tough. And they probably make their product in China, and I think the tariffs are probably going to put a headwind, going to be a problem that they're going to have to face. So that's one thing that, man, I'm surprised. Now, this is an apparel company. I don't love apparel companies. I don't like footwear companies because their margins aren't as good as, let's say, technology. In this case here, this company has really nice margins because it's Lululemon. They get to charge more for their apparel, for their leggings. 59% margins. That's very good. It's very good for an apparel company. That's terrific. And they get to keep a lot of that in the form of profit that falls down the bottom line. And their free cash flow is 15. That's not bad. When we look at their cash flow rate, $1.5 billion, call it 1.6 billion. And the type of company they are at their current growth rate, I'd probably say just high level. I haven't done any deep diligence on Lululemon. I would multiply the free cash flow by 15. And that would get us to about 22 to 24 billion dollars of market cap value minus debt. Let's see if they have any debt. So they have a little more cash than debt, so that's positive. So these guys are worth 22 to 24 billion, but the market cap's 39.7. So based on the cash flow that Lululemon's producing, the type of business they are, their growth rate, this business is priced too high. Maybe tomorrow it's going to be priced a little closer because they're going to lose 22% of the market cap. So 22% off of this is going to bring them down to about $30 billion in market cap. That's still too high. That's going to still be high by, I don't know, 20%. So this one's going to be a pass for me. I'm not overly excited about apparel businesses. I don't think they're a long-term success story. And you could see that now Lululemon, which made leggings a really popular accessory, fashion accessory for ladies, is seeing a lot of competition from Nike as well as other brands that come into the space. And Lululemon is an expensive product. I think there's a lot of less expensive alternatives. So a lot of competition is eroding and making it hard for them to continue to grow. So I think that's part of the undesirable aspects of that business. So Lululemon is a pass for me. I'd rather have businesses that are just stronger at having great barriers of entry and keeping competitors away. The other business that was out there was Samsara. And before I do that, let me say hello to everybody. 1 second. Looks like I've got some comments. Brian Hilliard, very good to see you. Yeah, the sell-off was induced by some tweets. Interesting. You know, I would say I'd be careful with buying the dip, and I'm going to come back to that in a little bit. Lululemon. Probably their guidance is what's really just torpedoing the stock. And the fact that, you know, just apparel is so darn hard. Even Nike's having a tough time at it. Rotel and Cheese, good to see you. David Knight. Do you own Micron? I don't. I don't own Micron. Good luck with that. I hope it works. So Mike, I think Mike's commenting on Lulu. Bad guidance, same store sales were low. Yeah, that'll do it. That's a problem. Genetic Smite, good to see you. Thanks for joining. Yeah, I'm not in love with apparel companies. If I look at the type of businesses that I would rather own, let me open up my desirability quadrant, and it gives me a visual to work off of. So I like businesses like Microsoft or NVIDIA or Google or even Alibaba that are at the highest right situation of this quadrant. In the green are companies that have strong moats. They also grow fast. They produce a lot of cash. They produce a lot of profits. And as you go down, you have businesses like Hewlett Packard. Their sales are actually contracting. They don't make a lot of money on their product. They have a lot of competitors. The business is drying up. There's just a lot of things that they have to contend with. They're in the red. Most businesses for me are undesirable, uninvestable in the red. In the gray, they're investable if I get a really nice discount. In the gray being, if a business has a strong moat, but they don't make a lot of money, they have tighter margins, they have less free cash flow. It's still investable if I get the right discount. And same thing with a business that's growing really well, but they don't have a really strong moat. They're still investable, but have to get a discount. And an example of a stock that I've evaluated recently is MongoDB. They have competitors, so they're kind of ranked down, kind of like halfway between the green and the gray. Lululemon would probably be at best in the gray. They'd probably be down here where their moat isn't super strong. They still grow, so that's good. And I don't know, maybe they'd be up here on second thought, but they would not be in the green. No way. It's just they have too much competition, and the competition's kind of eating away at their market share. So that is Lululemon. See if we can find a company that's trading up. Man, I'm on a losing streak here. We had Broadcom that was down, Lululemon's down, Samsara's down 11.77. Man, the gods are angry. The stock, Wall Street gods are angry. This stock is down 11.77. This company provides Internet of Things solutions. So Internet of Things means you can have a machine beyond the internet, and then you can basically communicate with it. You can write code that can help operate that machine. It could be an air conditioner. It could be a supply chain manufacturing machine. It could be a tractor trailer that your company owns. You want to track where that tractor trailer is. You want to be able to know its rate of speed, all that kind of good stuff. That's Internet of Things. And it is a category that these guys do well with. I've looked at this company in the past, and it wasn't good enough for me to invest in. It is a smaller cap at 27 billion. They are going to take a pretty good haircut tomorrow, bringing it down 12%. So that would be, it's going to bring it down to about 22, 23 billion in market cap. The revenue is 1.25. So you're paying a kind of a premium for the stock because you're paying 15 times revenue or so. Forward P is really high. They better be growing because that's a really high forward PE. Their revenue growth is good, 33%, 43%. It is a kind of a smaller company, but that's pretty good revenue growth. So the company has pretty good growth, but the fundamentals, the metrics are looking pretty expensive. Let me make sure I'm an annual. Yep. Let's take a look at free cash flow. Free cash flow is 111 million. They just started to cash flow in the trailing 12 months. And it looks like they finished their full fiscal year February 1st. So this is for the full fiscal year, $111 million free cash flow. Gross margins look really good. As they get bigger, this is going to be a profitable entity because they have really good margins. So this one needs to go back into the oven. It's not quite cooked well enough. I can't get to their valuation with this small of free cash flow. And it looks like the stock's really selling off, probably because of guidance. Let's see if we have any notes here. Yeah, this one, it needs to show stronger numbers. And here's why is Samsara is a technology company. Most definitely what they do, I can get better value from a company like Qualcomm. Qualcomm is a proven player. It's bigger, it's growing, it provides tremendous cash flow, profitability. I know what I'm buying into here. There's going to be fewer surprises with Qualcomm, where this one is going to be like today, full of surprises. Over the year to date, this one is up 0.15%, soon to be in the red. Over the 1 year, up 41%. That's pretty good. 41%, it's really good. Even after today's haircut, still going to be a pretty good performer for the year. But it's just not the right investment for me. I think there's too much risk, and I can find, I think, better fundamentals in the same sector that I think I can invest in and make money. So Samsara, it's too bad that they're selling off. It's a smaller business. I'd rather see them do well, but they're not. They're getting beat up. All right, let's talk about quantum computing. I think that's what quantum. So Rubrik provides data security solutions. So I had it wrong. This is not quantum computing. This is security. Okay. And it's down just a little bit. Not bad. Year to date, this is up 50%. For the 1 year, it's up 220%. Wow, this is a real good performer. So what's the story on these guys? They've got my attention. What's making them so darn valuable? Let's take a look. What do these guys do that is special? So these guys are cybersecurity. And I did a video on CrowdStrike. And the point that I made is this space, I think some investors believe, hey, cybersecurity is like always going to be in demand. Can't argue with that. But the piece that I think is missing out of that thought process is how many companies compete for that space? And I'm here to tell you, many companies are trying to get a piece of that pie. And that competition is going to be good for everyone. It's going to be good for the customer. It's going to be good for the technology and for security. But what it's not going to be good for is the stocks of these companies, which like CrowdStrike saw a sell-off today. I think they're feeling the competition. They're not growing as fast as they should be in order to sustain that really high stock price. Palo Alto's had its problems on the stock price level. You have other stocks that have really sold off. And this one here is showing up, doing really well because cybersecurity is hot. But a lot of these stocks get priced way too high. At the end of the day, we're buying companies that are going to deliver profits, cash flow, return that capital back to us in the form of buybacks, loading up the balance sheet with cash, and benefiting stockholders. We're not buying a cool, technology because it's cool. No, we might buy a t-shirt because it looks cool, spend $20, $30. We buy stocks that produce cash flow, produce profits, have great barriers of entry to keep competitors out. They're just set to grow. So let's see if this one qualifies. So these guys are in cybersecurity. All right. That looks good. And looking at their fundamentals, and I'm not seeing their latest and greatest, but we'll work off of these just to get kind of back of the napkin kind of calculations. These guys are a small company. What was their market cap? 19 billion. Their revenue is for the full year 2025, because it closed January 31st, $847 million. So you're paying 22, 24 times revenue for the company, which is a pretty expensive stock. They are growing nicely, 41%. Let's take a look at their investor page and see if they have it down here. And see what kind of growth they reported. So okay, so first quarter subscription revenue grew 38% year over year. So the growth of 49% is very good. That's pretty darn solid. That's impressive, 49%. Okay. They're in Northern California. Cash from operations, 39.7. Okay. So now they're producing free cash. That's very good. Have cash on the balance sheet. Very good. And they're guiding that they're going to do second quarter revenue of 281. So they're going to grow sequentially, 281, all right. The revenue growth looks really good. 49% is impressive. They are small, but it's still impressive to me. These numbers look really good. Look at their balance sheet. They have roughly, it's going to be 660, about 860 million in cash. Do they have any debt? So this is the debt level here, 322. So they have a surplus of $500 million of cash. Very good. This is where the business is making a turn from being cash burning company to cash positive. Cash from operations look good. And they don't have to put a lot of capital back into the business. This is a software company. I like software companies for this reason. If they don't have to put money back into the business, they get to really keep a lot of that profit. So looks good. Looks good. So this is going to be a good one to take a look at. So this is about $37 million of free cash. So let's take a look at, I'm going to do the trailing 12 months figure in my head. Here's free cash flow. We had 37 plus 78. It's going to be 125, 143 minus 29 would bring us down to 124 million in free cash flow trailing 12 months. Now they're growing really nice. So I'm going to multiply that times 30, and that gets me to call it $36 million. So this one is a good stock to drill into and see if they're going to be worth it. Now, the thing that's interesting is this stock's already gone up. Man, this stock's done great. But it's always hard to gauge that. They weren't growing all that great in 24. So anybody who invested here really saw the growth coming. I guess they really believed in the technology. And even in that year, the gross margins looked terrific, 70%, 76%. And the free cash flow margin was negative back then. So it was kind of a hard stock to see the potential. But now that the potential has been released and it's obvious that, hey, these guys are generating cash, they're growing really well, their product is really liked by the market. When you grow 49%, it's not because, it's a terrible product. It's actually the flip side. It's probably a really good product. These guys are probably eating away at CrowdStrike, Palo Alto, all the status quo players. These guys, this is their nightmare. Oh no, Rubrik is a new company coming in and taking our business away. So this one looks really interesting. I'm going to do a deeper dive on my own time and release a video. This one looks neat. I like little software companies. I made money on Zscaler, got in, got out. I'd love to see this stock through, do a full evaluation, and then buy it at the right time. It's on a really nice run, right? You look at this run. It went from $51 a share to 98. Okay, I don't know that I want to buy right now, but maybe if we have a nice sell-off and this thing comes down to like maybe, I don't know, $60 a share, $65 a share, man, I would not be able to resist. So this is a nice find. This is a nice diamond in the rough. I'll have to do some analysis on it and then get it ready for prime time. All right, this is why I do these live streams. Got to kind of sweep the market, see where there's some opportunity. Let me catch up with some comments and then we'll head over to DocuSign. All right, so, oh man, I think I'm way behind here. So Genetic Smite, I think I said hello, but if in case I didn't, good to see you. David Knight. Okay. Rotel and cheese. Yeah, Circle had a great IPO. I plan to go over that one. I was impressed, and I've got some comments there around crypto as well. So Mike, SoFi, and Oscar went up. SoFi, Oscar, and what are the markets doing after hours? I mean, every stock we've looked at that announced their earnings, even this company that had stupendous growth, is in the red. Geez, so it's just we have an expensive market. Okay, I was actually saying this to Mike, the dividend investor guy on Discord. I think I said it either today or yesterday. We were chatting. The market sold off, off of the highs, and it sold off pretty dramatically. But then it turned around and just made a lot of that up. Okay. Well, we're back to a pretty high level. Okay. And we had a terrific 23, 24, and the market year to date is only up 1%. But I think the market's getting expensive. Now, could I see a sell-off of like 5, 10%? Absolutely. I think that's kind of potentially there if you have the right story with enough negative press. Boom, we can sell off. And we can get some of that euphoria out of some stocks. And I'm guilty, just like anybody. I own Robinhood. Just been on a rocket ship ride. And I call it my favorite casino stock because I love their fundamentals. I'm not selling my Robinhood stock, but it's just been flying up. I've got a couple others that have been going up a little too fast. Well, that type of behavior is just too much exuberance. It's better to see a company execute really well, deliver really good earnings, and go up over time. Every once in a while, you discover a company that's been kind of left behind and it needs to catch up. I get that. But some of these stocks are just going up forever, and that's just not sustainable. They're going to come down, and the investors that got in late are going to be tortured because they're going to lose a lot of money. And Rubrik is an interesting stock. I'm going to take a closer look. Looks like Tony's on. How are you? So you're talking about Circle there, Tony? So Tony's in at 290 a share. Man, incredible how that IPO went. But I'll get to Circle in a bit. Let me try to get to the comments, and then I wanted to stay on track here. So Rotel and cheese. Cool. Nicely done. You probably did really well on Rubrik. Rotel and cheese. Very cool. Good to know. Sergio, good to see you. So the dollar's losing value against the euro. Interesting. Man, my next European vacation is going to be more expensive. All right. Well, I better do it. I better get to Europe fast before it gets worse. Metal Notice. Yeah, the market was kind of terrible today, but overall, man, I'm having a great week. I'm not gonna lie. It's been a good week. It was a great May. So hopefully it's not super ugly tomorrow because it's feeling like we may open really down and just be a sell-off day tomorrow. Shadow guy. Yep, agreed, buddy. Good to see you. Tony. Okay, cool. So Tony, which stock are you referring to? Are you referring to Circle or something else? Or is it UNH? So I think I missed this one here. So Mike, the dividend investor guy, UNH has been dropping all day very badly. I noticed that. So let's take a look at UNH real quick. But before I do that, we're going to look at DocuSign and we're going to look at Circle. Geez, look at this. Geez, stock market is angry. DocuSign tends to do this after earnings, and I don't quite understand it. See this drop off here? Let's look at it tends to have earnings, and if we look at 3 months prior, would have been February. No, sorry, it would have been beginning of February. So it was right here, and the stock dropped, and it came down, and then it had started to rally, and it rallied nicely from its bottom. The 1 year, it's still up 73%. 5 year, not so pretty, because it was one of those COVID darlings that, oh, everybody's going to do DocuSign, which was kind of true, but if you bought it at the right time, you're doing well with the stock, which is the case for me. And now it's really selling off today. Oof, caramba. So tomorrow is going to be a tough day to be a DocuSign stockholder. Let's take a look at their earnings. What the heck happened? This is June 5th. Let's take a look at earnings slides. I'm not going to be surprised if everything looks like, well, they did well. Why the heck is it selling off so much? But let's take a look. So total revenue year over year grew 8%. Now, what was it historically? 8%. 8%. So, okay. So the market's flipping out, and it came in kind of where it has been historically. Okay. All right. So free cash flow, 30% free cash flow margin. That looks really good. Okay. Of course, like any software company, they're saying, hey, we're developing AI for our solution. Okay, maybe. I say maybe because I think everybody's saying they're developing AI. How much of it is truly a big leap forward? I'm going to wait to see it and use it before I'll claim that, oh yeah, they're actually an AI company. So these guys here, international growth is growing nicely. They're selling down in Brazil. Okay, they're selling in Europe, Japan, and Australia. That's good to know. Okay. So these guys are baked into these solutions, right? When ServiceNow is selling their software and they need things signed, instead of kicking out of documents for somebody to wet sign, they use DocuSign or Salesforce or Microsoft. Everybody's a good partner with DocuSign. So this is where year-over-year growth, they came in as expected. Why is the market flipping out? Subscription revenue is good, billing growth. So maybe the billings came down a little bit, and that's what's the problem. But the billings are going to be, they recognize the revenue and they just haven't billed it. So I don't understand why that would be a big problem. So I'm going to move on. Gross margins, 82%. I'm good with 82%. I'm very good with 82%. They hired some more people. Thought AI was going to reduce headcount, but not here. I guess they're growing their business. All right. Then here's cash flow. Cash flow looks good. See, these cash flow yields, very good, very high. That looks great. 228, and the first quarter was about the same. Okay, good. All right. So their guidance. So then maybe this is what's the big problem. So total revenue, they're at 777 for the quarter. And this is the quarter they just closed. So the quarter here, they're going from 717 to 777, which would be $60 million of growth. Divide 60 million by 717. That's going to get us to roughly 8%. So they're going to grow by 8%. So that's not a big, like, uh-oh, data point. So I'm not seeing why these guys are getting hammered after the hours, after the market closed. Yeah, so these guys are coming in as expected. All right, see if there's any headlines that give me a clue as to what the market's not liking. There's no comment there. Nope, no comment, just data. So this one here, DocuSign, is a software company. They've been, let me look at the 5-day. They had been in a rally over the 1 month. They'd been in a rally, and now they're just getting tortured after the market sold off. I own a number of shares of DocuSign. I have a very good cost basis, but it still hurts when you see a stock go down 18.68. It feels a lot better when it's positive 18%. So we'll see where things settle tomorrow, but I'm going to update my data and maybe buy into DocuSign. Let me show you an example of how I value companies through DocuSign. So here's DocuSign, and I'm valuing the company. Their cash flows came in at about the same level. And what I try to do is value the company based on free cash flows. That's how most successful investors have done it. So I've created this model. And if tomorrow they go down by 16 or 18%, they're going to be even more discounted. Now, earnings per share, I'm going to open another screen that you guys can't see just to get that data. Let's take a look here. So we're in fiscal year 2026. Earnings per share is supposed to be 357. So they're going to be discounted by about 20 to 25% tomorrow, maybe a little higher. And this is kind of a stock that it's not a bad stock to own, especially I think they're a really good acquisition target. But this is how I get to an intrinsic value. The intrinsic value of DocuSign is $117 a share if I measure or value the company based on its cash flows. Discount all the cash flows I expect in the future by 8%, which is a rational discount rate for a company that has a really good balance sheet, which these guys do. They have far more cash than they do debt. And then I can make decisions on, well, I know that based on cash flows, this business is worth more. Maybe they become a really good acquisition target because a company could come in and buy this business that has 82% margins, 8% revenue growth, really high free margins. And maybe it's a product that has a lot of synergies with the company that's acquiring them. That's totally possible. Like a ServiceNow buying DocuSign, that would make a lot of sense. Maybe even a Microsoft, that would make a lot of sense. So maybe that happens. And if that happens, boy, it'll be a windfall for DocuSign stockholders. So this is going to be a hold for me. I have no problem holding it. It is going to be a little bit of taking some tough medicine tomorrow as I see the stock price come down. But I'm sitting on a really nice gain, so I should be all right. So that's DocuSign. All right, I'm going to make myself a note to update it a little later. All right, we covered a lot of ground. We covered Broadcom. We covered Lululemon. We covered Samsara, Rubrik. It was a really nice little find here in Rubrik. Cybersecurity company that I hadn't really paid much attention to, but boy, they're really rocking. Talked about DocuSign. Let's talk about Circle. And boy, Circle had a day, huh? they had their IPO, and it's good to see the IPOs are really, really doing well. So, no, that's not correct. What's their symbol? Somebody know the symbol for Circle, the stablecoin company? Yeah, this is it. So Circle Internet Group, CRCL. It's not on Google yet. Wow. Maybe Google's got to update their app a little bit. So, man, I did a survey out there. How many people are willing to buy it on its IPO day? And boy, you would be sitting on a nice gain. This is not how I buy IPOs. IPOs tend to sell off. Let's go with who should I use here? Trying to find Coinbase. Coinbase would be a good one. So Coinbase, I think they went public a couple of years ago. Here it is. And you see, this is what tends to happen is Coinbase did go public, a lot of fanfare. The stock was really expensive, $342. It hasn't returned to that level. Even after it's been producing phenomenal profits and cash flows. So if you wait, which I did, then you can really capture great profits. This is what I expect out of Circle, something like this. Not exactly this graph, but that's what I'm expecting. So Circle, let's take a look at some of their financials if they're available. Man, they're small. So you're paying, what are you paying for revenue here? So it's 18 billion in market cap. That's not too bad. Paying 10 times revenue. Okay. PE, they do have a PE, so they're profitable. Now, what's cool about crypto is these companies do make very good money. Revenue growth is very good. Okay. And they're already cash flowing. Holy smokes. I'd probably value them at 9 to 15 billion at this point. It's really hard to value a company that like this, but I'd say 9 to 15 billion would be my range. Margins 24% because they're issuing out stable coins in the cryptocurrency industry. They do have profit, they do have free cash flow. Cash flow is better than overall profit, so it looks good. So it's incredible how much it's risen, but I am going to wait. I'm going to wait because I think it's going to resemble this chart. And if you buy at the right times, then you'll make money. If you buy at the wrong times, you will lose money. That's just, that's just the way it is. And this is a tiny business. I mean, it's great that they had a good first day, but it's a small business. They could stall growth. They could grow even faster, but there's just a lot of risk. And I don't need to take those kinds of chances. I'd rather buy more Coinbase stock versus Circle because I know what I'm buying into Coinbase. But interesting. I'm really happy that we had a successful IPO. That is great to see. Awesome. Nicely done, Circle. All right. So that was Circle. And Anthony, you're on UNH. Great. So Sergio, yeah, I think Robinhood is up a little too much, truth be told. I still like buying as a hold, but I'm not adding any capital to that position. I'll take a look at UNH. It's getting late in Switzerland, shadow guy. Oh man, look at you. Mike the dividend investor guy coming in with a nice low acquisition price on DocuSign. I hope it goes well. So you want to take a look at Uber. All right, so we got a list of stocks we're going to go over. We covered Circle. Interesting. We covered Rubrik, and I've got that one as homework. I've got DocuSign as homework. Avgo as homework. The next one on the list is SoFi. What's going on with SoFi? What has it been doing? It's was up a little bit, and SoFi is a popular stock. It is down year to date 11%. Over the last month, it's up about 6%. All right, last 5 days, okay. So year to date's not doing great. And I've always said the difference, like 2 years ago, I had the same opinion as SoFi, is they picked a part of the market that is not as profitable. And I'd rather buy Robinhood. That's what I said 2 years ago. And I'm really glad I did so, because Robinhood's just been a phenomenal hold that I'm glad I went with Robinhood, because they're kind of in a similar industry, trying to do, going about it with a similar strategy, which is come in and disrupt, and take over a market. And again, I like the market that Robinhood's going after. I don't like the market that SoFi's going after. I think they're two different things, and that was my difference in appreciation. And I think I made the right call. Going with Robinhood was the right decision. Now, going forward, would I change my tune? No. I'm excited about Coinbase now, because if Circle is going to get that kind of attention, I'm sure Coinbase is going to get more attention. I'm beginning to sell my Bitcoin, and I know some of you are going to frown upon that, but I've been an investor for a while, and I want to cash that out and put it into stocks. And one of the stocks that I'm going to put it into is Coinbase, as well as some others that I've got my eye on. So SoFi has just not been one of those stocks that I can appreciate, because I think their margins and so forth aren't good enough. That's just one opinion, guys. But I'll give you my opinion the way I see it. Revenue growth is okay. It's good, 23.62. It's very good. So these guys are more like a bank. So we're going to look at balance sheet, take a look at the book value growth. You value banks differently. And here's where it's a little uncomfortable, that they've been at 5.29, 5.58. It hasn't grown a whole lot. Book value hasn't grown. You want book value to grow fast. If you look at JP Morgan, that's gold standard for banks and companies like SoFi. You want to see a nice appreciation of book value, 10, 20, 30% per year. And these guys haven't shown it. Since 21 to the trailing 12 months, they've grown about 70, so that'd be about 14% over 4 years. So that's really only like 3% annual growth of book value. It's not very good. Don't like that. Going back to the income statement, they are profitable now. Profit margins 17. That's very good. We don't look at free margin for a company like SoFi. It's like a bank. But 17% is good. Yeah. If they continue to grow, they're going to be fine. I might even turn my opinion on SoFi around if they continue to grow. So they're at 20% growth rate. Yeah. So over the last, let's see, over the 5-day, doing okay. Today they had a good day, 1 month, and then the year to date, that's where they really got sold off. Well, to everybody who owns SoFi, I hope it starts to rally and has a really good run. I'm gonna hold off. Maybe I'll change my mind about SoFi in the future. If they grow, I think I'll end up changing my mind. But for now, I'm still a seller of SoFi. Oscar, let's go over Oscar, man. Geez, these guys, this was a pleasant stock to look at today. It was up 10.6, and at some point it was like up 18%. It's like, geez, and I couldn't find the story. Like, there's no stories on it. It's just, I think people started buying into it. It's a smaller cap, so there's not a lot of shares out there. So if you have enough, especially big buyers, it puts a lot of pressure for the stock to go up. So this stock is a good stock for me. It's kind of a higher risk, higher reward situation, but I love this growth. I mean, this is really, really impressive growth. They keep growing at these levels, and they have an addressable market that's massive. They're trying to sell to small businesses or individuals, and that market's massive. So they can really grow for 10 years. And the big guys like United Healthcare or Elevance, they don't really want this market. They're going to let Oscar take it. And if Oscar can take it and make money at it, look out. These guys are going to be just worth so much. They have great free cash flow. Their free cash flow margin is 11.82, which is excellent. Health insurance companies don't have terrific margins because they deal with volume. They sell a lot of policies, and they just need to be able to have a positive rate of they sold the policies or more and they had to pay out less, which is the case for Oscar. And then they get to keep a lot of the cash, and they get to work with the cash while they hold it. Like, policyholders will pay Oscar in advance, and then obviously as things come up, they go to the doctor, they file their claims. But in the meantime, Oscar can invest that money and make more money, or earn a yield while they hold that cash. So those things I really like. So Oscar is going to be a good stock for me. I'm hoping it's like Robinhood, but it has had its volatility. Look at that, man. Who needs roller coasters when you have Oscar stock? And at their last earnings, boy, did it go up, huh? It went from $13 a share to 17. So it was a nice 30-day gain, 30% gain in one day. And then it sold off pretty hard. And today it had a nice rise. So overall, the 1 month looks good. Year to date looks good. A lot of volatility. So if you like volatile stocks, I got a pretty good stock for you to look at. Because you could buy low, you can buy at these low points and then watch that stock go up. I did pick up some shares when it dropped down. I picked up shares back here, so I'm glad I did so. And Oscar, for now, isn't going to be a big bet. Even with Robinhood, I didn't bet a ton of capital. The stock's taken up so much that now it's become like probably number 5 or 6 on the most valuable stocks in my portfolio, maybe around 6 or 7. And I just don't sell any shares, and I add from time to time. But this one here, if it takes off, I think it's going to resemble Robinhood. We'll see. That is Oscar. I like that little company. I like disruptor companies. I like that they come in and provide value to the end customer. They do it in a way that totally makes sense. They have the right people, they have the right ideas, right technology, and then they go into a market and transform it, disrupt it, make it better for the customer, probably make it better for everybody that's involved. Go Oscar. United Healthcare is in the same business as Oscar, but they've just been getting abused. Oh my gosh, look at that. Down 41%. Just getting shellacked. And I'm buying shares. I bought shares twice today. I put in 2 orders. And this is just unreal. I made money on United Healthcare. Years ago, I sold in 2021, beginning of 22. And United Healthcare made me a lot of money, man. So I'm like, what is the market thinking? Look at this stock. It's been a phenomenal stock. And look at this drop. It's dropped it to where the stock was trading in 2020, which is kind of nuts because the business is much larger than it was in 2020. This is a very good business. Let me show you. So 2020, their stock price is now matching 2020. They were 201. Am I looking at the right total revenue? Okay. So they're 257 billion in revenue in 2020. Now they're 410. So they added 150 plus billion dollars of revenue. Okay, well that should count for something. And then we've got cash flow. In 2020, $20 billion of cash flow, but now they're at 25. So they added $5 billion of cash flow. Again, that should count for something. And they have positive margins. Again, this is the health insurance business. They're not going to be crazy margins. And then they have free cash flow margins. But their top line, their overall revenue is so big. If they earn a good rate of free cash flow and a good profit rate on such a big number, it makes them a very valuable company. They also have great barriers of entry, moats, because switching from United Healthcare, big corporations, they might have 100,000 employees. They're all, being insured by maybe United Healthcare. And switching is super tough. People don't like to switch healthcare insurance. I can tell you, my wife would not want to switch. We use United Healthcare, so we're happy with it. And so overall, I think this business is just being discounted and it's too attractive. It's just a good buy. I think I'm going to double or triple my money in the next 2 years. That's just the way I see it because this stock has done it. This stock, the company hasn't changed. Yes, they've had really, really bad news. Having your CEO murdered, assassinated, terrible. Having another CEO that was kind of pushed into the role, retire, that's also bad. But I think if they can get their leadership sorted out, the core business is far more valuable. And I'm optimistic that this business is just going to thrive. I'm sure a good CEO is going to come around and say, I want to lead United Healthcare because they are such a valuable business. It would be quite logical and rational for a qualified CEO to take this job versus a job like Nike or Starbucks. Those businesses are not that great. They're okay. We know about them, but man, it's really hard to make money. And the competitive advantages that those businesses have are not very good, where a company like this has really good competitive advantages. So I like United Healthcare. I'm going to keep buying it. I'm probably buying United Healthcare fastest of my current buys. This is the one that I'm really loading up on. So United Healthcare. Another one of my favorite companies is Uber. What did it do today? It did well today. Man, everything's down aftermarket. Why is the market so blue? But look at this revenue. Boom, 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 boom. Green. The one red year was COVID, right? We had all the restrictions on. People weren't traveling. All kinds of things changed that 1 year. Look at this cash flow growth. Show you a pretty chart. Look at that pretty chart. They went from negative to positive, and now they're just growing their cash flow like crazy. Good job, Uber. Profit margins 27%, free cash flow margins 17%. They can grow without having to deploy a bunch of capital because drivers bring their own cars. And they don't hire employees. These drivers are subcontractors. So it's a very, very good business. And they are growing their top line. They're growing their profitability. Overall, the news around, Tesla coming in with their robo-taxi, Well, I think the Tesla stock is kind of on fire in after hours, right? Let's take a look. Yeah, let's take a look. Yeah, it was on fire today. Then we got this. So Robotaxi in Austin's supposed to launch on the 12th. And I mean, you would think that their CEO would be totally locked in on, let's make sure we have a successful rollout of Tesla Robotaxi in Austin, because that's going to move the stock. If it's successful, the stock's going to rally. If they show up with like 5 cars are really on the streets of Austin, the stock's going to sell off big. Instead, it created like a big forest fire within the stock. So I am so glad I do not own Tesla. I'd hate to be a Tesla stockholder. What's going to happen over the next 7 days? I don't know, but it's not looking good. We'll see. PE 162, expensive. Then you look at their growth. What growth? There is no growth. 1%. Everybody says they're not a car company, they're a tech company. Well, why do they sell so many darn cars? They better stop selling cars if they don't want to be called a car company. Because those cars, very low margins, very low cash flow. And I don't think it's a very good business. You look at their cash flow, it's okay. But if you're going to be a $1 trillion market cap company, I showed Broadcom earlier. Broadcom was at 24, 25 billion a year. These guys are at 6.7. Just terrible. You can get far better in other companies. Gross margins, 17. This is lower than Lululemon. Profit margin, 6%. That's terrible. Free cash flow margin, 7%. So people buy into Tesla because they're impressed with, hey, this guy launched an electric vehicle company. Got it. Yeah, SpaceX, incredible. But we buy companies that produce cash, profits, and are going to return that capital to us. If I want to go see a rock star, I'll go see one of my favorite rock and roll bands. And I'm out a couple $100, had a good time, and I go back to managing my portfolio and make hundreds of thousands of dollars per year. That's what I'd rather do versus buying a stock from a celebrity CEO. I'll just watch the show, eat some popcorn, and watch this soap opera. So that is Tesla. And we talked about Uber. Let me show about, so we were talking about Uber. We'll see where Robotaxi goes. I think it's ridiculous how this stock is sold off at times with the threat of Robotaxi, but year to date, it's doing great. Over the 1 year, it's doing okay, but this year, it's really stood up. Some big investors have come into Uber. Check out the big money that's coming into Uber. These are not dummies. These are like investors that are out to make a very good return. And when we look at Tesla, I thought there was more. So, no, I'm sorry. That's thinking Uber. I typed in Tesla. Geez. AI cannot get to me fast enough. AI would have been reading my thoughts. Ackman bought into Tesla. There I go again. Bill Ackman bought into Uber. David Tepper bought more Uber, bought 113% more. These are like, this guy's number 1 on my rankings. This guy's a very legit super investor. Look at all these super investors. They know that Uber has tremendous value through their cash flows and profits, and they are not believing the whole robo-taxi thing is going to hurt Uber. It actually could create a new business line for them. Boom. They harness, because they're already partnered with Waymo, which is truly the leader right now that's in the commercial stage of robotaxi. But Uber is also partnering with the Chinese robotaxi company. They're already deployed it in Abu Dhabi. They're going to deploy it in the Middle East, other parts of Asia. So you look at Uber, and Uber is going to take on robotaxi, benefit from it, grow its business internationally and domestically here in the US. So I love Uber. I'm good with Uber. I'm going to make money on Uber. Uber is my third biggest position in my portfolio. So rock and roll with Uber. All right, we're cranking along. Probably a little late on comments here. Let's take a peek. Saeed, so you have a question, and your question is, for almost same price, would you buy A-Lab or Uber? Uber. I think Uber is a more definitive winner, and that's my answer. A-Lab could be overall a bigger winner, but it could also, there's a higher likelihood that A-Lab is going to get beat up and the stock price is going to drop. There's going to be a lot of volatility. So for now, my answer is Uber. That's the one that I'm buying into. I'm holding off from adding any more A-Lab. And I own a lot of Uber, by the way, and I still add to it. Thanks for the question, Saeed. Have a nice dinner, Mike. Yeah, Tesla did move back into the after hours positive, but it had a tough day. Android PC, what's up, buddy? All right, guys. Man, that was a good stream. Excellent stream. We have a lot of people on the stream, guys. I'd love to see you guys join the channel. I'd love to get you guys on member calls. Here's the different programs that we've got available. There's 3 levels. Take a look. It'd be awesome if you could become a member. And just FYI, I really want to reward people that are supporting the channel through their subscription each month. So all like due diligence on individual stocks is going to be member only going forward. I think that's a way of really separating my research and just rewarding and showing my appreciation for all the members. And I really do appreciate it. We've had a good number sign up in the last couple of months. I also have a couple of members that have been around for a long time. I especially appreciate those members. I invite all of you guys to become members. I think it's really worth it. You can take a look at the details on the channel homepage. It includes, member-only videos, the tools that I exhibited, all the valuations that I perform. I pretty much provide a copy of this once a month. I refresh it. So 24/7, you can look at my research. So that should be interesting. And you can have access to other tools that I have out there, including a retirement model. You get invited to member calls. And then I'll live streams. If you have a stock you want to look at, pop it in the chat and I take a look at it. So Tony, what do I think about collectibles as investments? I don't, that's not something I do. I'm not a big collector, so maybe not the best question for me, but my answer would be I don't treat them as investments. I buy cars, I use cars, it's cool. Real estate, I also accumulate. I like real estate, but you have to buy it at the right times under the right conditions. But I'm not like an NFT guy. I'm not a art guy. Some people are. That's not me. I could tell you the intrinsic value of a company looking at their financial statements. I couldn't begin to tell you like, hey, this painting was from this famous artist. What do you think it's worth? I'd be like, I don't know. I have no idea. So I'm going to stay in my lane and look at companies. I could also do bonds. I can do real estate because real estate has cash flows. You can model it. You can determine what real estate's going to be worth. So those are going to be probably my 3 big investment classes. So thanks for the question, Tony. And Eric, thanks for tuning in on X. Yeah, I don't own any art, man. I mean, I own a couple pieces. Like, I bought pieces from a street artist. Like he did. I like paintings of robots, and I own a couple pieces there, but I can't say they're worth anything. I just bought some of those and just some general art that we have at home, but nothing that's like, oh, this famous artist painted that, or some maybe a new artist that's pretty hot painted that. No, none of that stuff. I do have a really nice garden at home, by the way. My wife and I work in the garden together, and we have a really nice garden, but I can't sell that. I'm not going to sell flowers like at the market or anything. All right, cool guys. Well, that was a great time for me. Hopefully it was for you. Hopefully it was interesting. Hopefully you got a few ideas on investments. Let's see how the market trades tomorrow. I have to think that we may have an ugly day tomorrow. It may be a little ugly tomorrow. We got a bad story brewing in Washington. I saw a lot of red on post earnings announcements. We'll see. We'll see what happens tomorrow, but I wouldn't be surprised if we have a nice red day tomorrow. So keep doing your research, keep finding good discounted stocks. If you want to learn how to do that, you've come to the right live stream. You've come to the right channel. That's what we do here. Try to find good companies that are going to be worth a lot more in the future, invest in them in the right way, and grow our wealth. That's what we're trying to do in this channel. And hopefully you can become a member. So everybody have a good night. Thanks so much for tuning in. I'll talk to you soon.